The World Bank has raised its global growth forecast for the first time in 3 years. This has been credited to advanced economies that started to pick up pace, led by the United States. The body predicted that global growth will expand 3.2% this year. That's from 2.4% in 2013. Well, for more, I'm joined by Alan Dennis, who's a senior economist at the World Bank. Alan, thank you so much for making the time to join us today. Now, looking at this report, I think one wants to know, a lot of investors, a lot of analysts look at this report. What is it that they're meant to get out of it, or how would they make use of this report?
Well, as you mentioned in your introduction, for the first time since the global financial crisis, we are beginning to see a self-sustaining recovery in high-income countries. And this is what is driving our projections for a pickup in growth to about 3.2% in 2013. Also, we see that for developing countries, growth will pick up from 4.8% to about 5.3%. And similarly too for sub-Saharan Africa, where growth has been somewhat resilient throughout this crisis. And that strong story of growth in sub-Saharan Africa continues to persist even in this year and going forward over the next 3 years.
Now, Alan, how big of a concern is the tapering off of quantitative easing when it comes to growth prospects?
Yes, as we all know, the tapering has already begun. The asset purchase program of the United States Federal Reserve started already in January, and so far, market's response has been muted. Our baseline assumption is that this process will continue to go on in an orderly fashion, and so whilst the tapering itself may lead to an increase in the long end of the U.S. Treasuries, and therefore will affect capital flows to developing countries. Our baseline assumption is that it will decline. Our calculations suggest that it will decline from about 4.6% of developing country GDP, that is capital flows to developing countries, will decline from about the current 4.6% of their GDP to about 4% of their GDP. So that's a moderate decline. But we also have to factor in that this is happening because of strength in these economies, and so that will translate into increased demand from high-income countries to developing countries. So we expect a pickup in trade, which has been very subdued over the past 2-3 years. Trade is expected to expand by about 5.1%, not the highest in recent decades, but certainly an improvement from the past 2 years. So when you take these two components, the fact that capital flows will decline moderately, and then you also take into account that developing countries will benefit from the strengthening in high-income countries. We think that the strengthening of demand from high-income countries will offset the tapering effects, of a decline in capital flows. But one needs to say, especially looking at the events of summer 2013, that there is no guarantee, even though we think that the possibility of a disorderly adjustment, in other words, a sudden quick rise in U.S. Treasury rates, which could in itself lead to a disorderly adjustment in capital flows to developing countries, which we saw in the summer. Our baseline assumption is that the probability of that happening is relatively low, but one needs to take that into account. And so for countries that have huge domestic imbalances, huge current account deficits and fiscal deficits. This will be a period for them to rebuild those buffers, such that, if it does happen, which again, I may stress that in our scenario, it's a low probability that will happen, but one needs to be prepared for that.
Okay.
If you look at
Alan, just to interject there, Alan, because there's quite a lot that
those countries that have very
Alan, just to interject there, because there's quite a lot that we'd like to get through to. Looking at some of the research in your report, what would you say are some of the other bigger risks that are facing sub-Saharan Africa specifically?
Yes. The other risk for sub-Saharan Africa is obviously China is in the process of restructuring its economy, trying to move from an investment-led to more of a consumption-led economy. And so that will involve some adjustments in terms of its investment rates. Now, again, in our baseline, we don't anticipate significant impacts for sub-Saharan Africa. But if these rates come down quite significantly, that could impact commodity prices, particularly metal prices, because China consumes at least 45% of metals. So if that comes down significantly, then the already slowing or falling metal prices that we've already seen will accelerate, and that could could have serious knock-on effects for the several metal exporters in sub-Saharan Africa. So that's a risk worth looking out for. Of course, in few or selected countries in the region, we have political tensions. Currently, we're looking at political tensions in Central African Republic, and its GDP is collapsed by a double-digit rates. And we see that interspersed in a few economies, not across the region, but that's something that we'd rather not have.
Now, Alan, you made mention of India and China, who have invested quite significantly in Africa over the past couple of years. Going forward, do you think this trend will change? Where do you expect to see money flows coming from?
I think the investment story for Africa continues to remain a strong proposition. Our assumptions are that capital flows to sub-Saharan Africa, which this year increased by 16%, that is from about $37 billion to $43 billion, will continue to rise throughout our forecast. We have up to 2016 foreign direct investment flows to sub-Saharan Africa increasing to about $47 billion. So that story we expect in our baseline to continue. And though a large chunk of it has gone into the natural resources sector, it's worth noting that there's also been significant investment in the services sector. This is including financial services, real estate, transportation, infrastructure. And so all of these will help to improve productivity in these economies, and again strengthen the growth story going in. The countries that we've seen strong investment in a non-natural resources sector vary from small countries, from resource-rich countries. So it's not a specific country, it's a wide array of countries. But all those countries are characterized by peaceful and domestic political situations. They are characterized by growing economies, growing middle income sizes, and so they provide an investment environment that are supportive of these capital flows.
Well, Alan, it was a pleasure talking to you. Thank you for your time. That was Alan Dennis, who's a senior economist at the World Bank.